if the project, let's say the projections are correct, they're going to make $1 billion of revenue from the 5 blade. Our question is, should we use 1 billion as the revenue for the project, or they're going to lose, let's say, $500 million from the existing 3 blade sales, because some of those 3 blade people will move to 5 blade. Since we're looking at the incremental cash flows, we have to use the 500 million. Yes, we're making $1 billion from the 5, but we're losing $500 million from the 3. So the net effect on the firm is $500 million. Since we are looking at the incremental cash flows, we only look at the net sales or costs as a consequence of accepting the project. More often than not, these side effects are negative side effects. I'll give you an example from our school. Last year we had what you want to call an MBA program that was face-to-face. Even though I don't like its design too much, but we had an MBA program. Let's actually look at what sort of enrollments we had. Come on. Let's see. Let's look at fall 2021. Actually, let's look at fall 2019, because that was before the and I didn't want to look at the time of the COVID. So we had, these are the first semester classes. We had roughly 20 students. Okay. Now let's look at there's nobody in the old ones. These are the eCampus ones. Maybe we should look at 22. Apparently, students have not registered yet. These are people that were already in the program, pretty much. Okay. It kind of varies around. Because some of the existing students were moved around, but this is a basic class. We have about 26 students. Same thing here, basic class. And Even with these, we seem to have some increase because we had some captive clients, but we're going to find out fall of 23 the actual effect. I can't simply look at here and say, oh, we increased the MBA students a lot. No, because we cannibalize our own product. I've seen the same thing happen when our undergraduate accounting program went online. We added maybe at most 10, 15 majors, which is in and of itself is good because that would constitute about 7, 8% increase. But in order to do that, we actually almost double the cost of delivering the program. Not only we have the face-to-face, but we also have the online program. In fact, because of that, some of the face-to-face classes, students have to take it on the e-campus, which is not of their choice. Even though it doesn't cost us additional money in terms of teacher salary, it costs in terms of learning quality. It has other costs. But either way, nobody actually made that kind of analysis. Now they're thinking about they're going to close out the existing design. They want to do a new, brand new face-to-face design. They don't even. I asked the question in a meeting a while ago. I said, "What's the break-even number of students to justify that as additional program?" They didn't even think about it. And these are people with PhDs. Why? Because they're ignoring the basic principle in capital budgeting. Just because our capital is coming from student tuition and the state doesn't mean that it doesn't cost something. So you should always think about the side effects. There are rarely positive side effects. By adding a new product, that may increase the sales of existing products. If you're a CFO and somebody under you comes up with a project that becomes valuable only because of the cross-selling opportunities like that, be suspicious. It's not like these people are lying. When I come up with a project, it's my baby, right? I put a lot of time and effort into it. It is normal that I have wishful thinking about things. But as a decision maker, you should be aware such biases exist and act accordingly. And when I worked in the financial sector, brokerage firm, every once in a while people came up with a project. They say, okay, let's do this, let's do that. And if we do this, we'll be able to do more business over there too. I only accepted those projects if they were profitable without the side effects. If we get the side effects, fine. But I always assume that they're not going to be there. It may be too drastic, but I'm not going to take that kind of risk as a manager. We're going to look at things like salvage of equipment. Just because machinery or equipment is depreciated to zero, because of its tax life, doesn't mean it has no value. Even stuff that's depreciated to zero can be salvaged. They are relevant. On after-tax basis. Let me write this on. There's a difference between market value of an asset, like an equipment, and its book value. Book value is historical cost of acquisition less any accumulated depreciation. And if you completely depreciated it, you're already at zero. That doesn't mean that its market value is zero. So if you have an equipment you sold at, let's say, $10 million, and as far as IRS is concerned, you have fully depreciated it, IRS is going to consider that $10 million completely taxable. Why? Because IRS says you bought this at $50 million, and over 8 years, let's say, you depreciated $5 million a year, which means you reduce your taxable income by $5 million a year. And right now in your books, it's worth zero. If you sold it at 10, you made money. If you made money, I'm going to tax that. Or sometimes you sell it under book value. Then you lost money, which means you can actually get a tax credit for that. Then our relevant concept of cash flow for the project is that of cash flow from assets, short CFFA, and we can write that as operating cash flow minus net capital spending and minus change in net working capital. You can think of the change in net working capital as kind of short-term investment or short-term capital spending. OCF is every year during the life of the project after year 0, we will form what we call pro forma income statement. And OCF is net income plus depreciation. And remember, calculating net income is calculated without interest expenses.